Before we start, a quick rule for how this video works. When I move, the video speeds up. When I stop, we learn. So when I'm moving, we're flowing and building. When I stop, that's where the understanding happens and that's where the marks are. Today we'll be covering IFRS 3, which is fair value measurement. And the most important thing to understand right from the start is that IFRS 13 doesn't tell you when to use fair value. Other standards do that, but IFRS 13 tells you how fair value is measured and disclosed. Once you understand that, the whole standard makes sense. The purpose and scope of IFRS 13. IFRS 13 exists to bring consistency. It provides a single definition for fair value, a framework for measuring fair value, and it discloses requirements so that users understand how fair value was calculated. But IFRS 13 doesn't apply everywhere. It is not used for disclosure in IAS 19, which is planned assets, IAS 26, which is retirement benefit plan investment, and IAS 36, where recoverable amount is fair value less cost to sell. It is also not used for measurement in IAS 2, which is net realizable value, and IAS 36, which is value in use. And lastly, it is not used at all in IFRS 2, which is share-based payments, and IFRS 16, which is leases. So IFRS 13 is powerful, but only when it's actually allowed to apply. The definition of fair value. Fair value is defined as the price that would be received to sell an asset or paid to transfer a liability in an ordinary transaction between market participants at the measurement date. This definition is the backbone of the entire standard because it tells us that fair value is one, a price and not a value in use. Two, it's based on market participants, not the entity. Three, that it's measured at a specific point in time. And lastly, number four, that it's based on an ordinary transaction, not a forced one. If even one of those elements is missing, then you are not applying IFRS 13 correctly. Asset or liability characteristics. Fair value can be measured for a single asset or liability, a group of assets, or a group of liabilities, or even a group of assets and liabilities together. So when measuring fair value, you must consider characteristics that market participants would consider, such as the condition of the asset, its location, and any restrictions on its sale or use. This reinforces a key rule. Fair value is market-based, not entity-specific. Exit price logic. Fair value is an exit price. For an asset, it is the price to sell the asset. For a liability, it's the price to transfer the liability. Transaction costs are excluded from fair value because they relate to the transaction and not the asset or liability itself. Transport costs, on the other hand, are included because they relate to the location of the asset itself. This distinction is small, but it's tested consistently. Markets and orderly transactions. Fair value assumes an orderly transaction, meaning willing buyers and sellers, no liquidation, and no forced sale. Fair value is also measured at a principal market. This is the market with the greatest volume and level of activity, which the entity must have access to. If no principal market exists, the most advantageous market is used instead, the one that maximizes proceeds from selling an asset or it minimizes the amount paid to transfer a liability. Measurement date and initial recognition. Fair value is measured at a specific measurement date. For example, investment property is measured at reporting date, Business combinations are measured at acquisition date. This means that at initial recognition, the transaction price is the entry price and fair value is the exit price. Often they are the same, but you never assume that without thinking. Non financial assets and highest and best use. For non financial assets, fair value considers the highest and best use. This is based on market participants and not the entity. Fair value reflects either using the asset in a way that maximizes economic benefits or selling it to someone else who will, even if the entity itself plans to use the asset differently. Fair value hierarchy and valuation techniques. IFRS 13 introduces a fair value hierarchy based on inputs. Level 1, this is for quoted prices in active markets for identical items. Level 2, this is for observable inputs other than those in level 1. And level 3 is for unobservable inputs based on judgment. The lower the level, the greater the judgment and greater disclosure requirements. Fair value is determined using valuation techniques that 1. Maximize observable inputs and 2. Minimize unobservable inputs. These include the market approach, the cost approach, and the income approach. So, IFRS 13 is not about guessing value, it's about applying the market based discipline at the specific date using observable evidence wherever possible. Once you understand that, IFRS 13 stops being intimidating and starts being predictable.